Imagine owning a piece of the largest hospital network in America for 30% off. That's exactly what Wall Street is offering you right now. HCA Healthcare, and a stock that has just fallen from $556 to $394. In this video, I'm walking you through every single number in HCA's financials. The bull case. For the trailing 12 months, HCA generated $76.4 billion in revenue. 10 years ago, that number was about $41 billion. That's a compound annual growth rate of roughly 6.7%. But the real story is in earnings per share. The TTM EPS sits at $29.08, up from $10.93 just 5 years ago. That is a 21% annualized EPS growth rate. Second, and this is the big one, share buybacks. HCA has been one of the most aggressive buyback machines in the entire S&P 500. In 2017, HCA had 362 million shares outstanding. Today, it has 223 million. That is a 38% reduction in the share count. Every share you own today represents a meaningfully bigger slice of the company than it did 5 years ago. The dividend is small, only 75 basis points, but the buybacks are doing the heavy lifting. And free cash flow, the gold standard for sustainable shareholder returns, came in at $7.93 billion on a trailing basis. That's a free cash flow yield of 8.88%. All right. Let's talk valuation. The current price-to-earnings ratio is 13.5. Forward P/E, based on next year's projected earnings of $33.22, is 11.86. That's a meaningful discount. Now, the discounted cash flow models. A standard 20-year discounted cash flow model, using HCA's $12 billion in operating cash flow and an 11.97% 5-year growth assumption, spits out a fair value of $1,261 per share. That implies the stock is 69% undervalued. A more conservative model, median PE times forward earnings, gives you a fair value around $420. That implies 7 to 12% upside on the multiple alone. Add in the buyback yield of 4 to 5%, and the dividend growth, and you're looking at potential total returns of 12 to 15% annualized.